Happy Friday, everybody. My name is Brent Moore. It's time for Advanced Option Strategies. We do that each week at this time. Glad you joined me. We're going to continue on our series. We're kind of just going through basic option strategies or basic advanced option strategies. I don't know how you say that. Essential maybe is the right word. It's option strategies over the past few weeks. This week we're on week 4. If you want to see past weeks, you can always go to the playlist. Today, calendar spreads. So, calendar spreads are very often used in a low volatility environment. And in case you haven't been paying attention, we're not in a low volatility environment, but I'm trying to be complete and thorough in the strategies that I go through. So we are going to hit up calendar spreads, and maybe we'll find some less volatile type stocks to look at here today. So that's our goal. When I say our goal, I mean my goal, and I'm joined alongside Mr. Cameron May. He's a colleague, he's a good friend, and he's helping us out in the chat. So we appreciate you, Cam. You can follow either of us on X at Brent Moore's CS, at Cameron May CS. And maybe Chris is the right word. The common advanced option strategies. That's the word I'm looking for. Let's hit those disclosures here. Options do carry a high level of risk and are not suitable for all investors. The information today I'm going to go through is for general informational purposes only. It's not a recommendation of any security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. And for the sake of simplicity, I may not factor in commissions and fees in everything we do, but just realize those are important things to consider. All investing involves risk, including loss of principal is potentially there, definitely. There's no guarantee an execution of a stop order will be at or near the stop price. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And past performance of any security or strategy does not guarantee future results or success. Probability analysis results shown are theoretical in nature. That's something we do quite a bit in this class as we look at the risk profile tool, look at probabilities and stuff like that. So glad to see some familiar names there. Appreciate you. And if you're watching, if you're a first timer, that's great. We're glad to have you. Welcome. All right. So we're going to do calendar spreads. First, I want to just take a brief look at the market, get kind of a market update. And for that, I'm going to use the Thinkorswim software. This is the Thinkorswim desktop software. If you're looking at Thinkorswim web, it's going to look a little bit different here on this. But this is the S&P 500. And hey, that's an old drawing. We're going to get rid of that one there. But, this was kind of the trend that we've had kind of right there. And we also have on the S&P 500 kind of my horizontal line is a little squiggly. That's supposed to be pretty horizontal there. We're kind of at this key area right now. I think this seems like a relatively strong resistance level. I don't know, this would be a good break if we can break above that, because old resistance, I'm going to put an R by resistance, can become new support. And just like old support can be new resistance. This was support back here, then we kind of banged into it there, and here. We're still kind of on the verge of that level. And that certainly, if we break through it, we could then consider that kind of to be more of a support level. But the name of the game lately in the markets has been volatility. And so this strategy we're going to talk about today is one where on the stock, we don't want it to go way up or way down. That's for calendar spreads. So we're probably going to have to look a little bit more carefully for stocks if you're planning on checking this out, because you want a less volatile stock. But there are some out there. There are some stocks that are moving less than what others are. Furthermore, when we say volatility, we don't just mean looking at the chart of it. I mean looking at the implied volatility of it. And for that, you can always bring up a measure of implied volatility. So if I pull up a stock, I'll just put up Coke, you can pull up volatility here and see where the volatility is now as compared to where it has been historically. I did a whole session on this on on Wednesday on our managing an options portfolio class. In fact, so I'm going to put a link in to that class there for those of you watching live. There's a link to that class if you want to see, if you want more in-depth on implied volatility. This we're just looking at implied volatility. There's other measures we can use. I discuss in that class. Also, if you're wondering, how did he do that quick link thing at the top of the page where you can just click and change things like this? Check out my X page today. I did a little video on that today on X, at BrentMooreCS is my handle, on how to use these quick link your charts here so you can bring up what you want on those charts. All right. So there we go. So that's the market right now. We'll see if that continues. Let me go back to SPX. Intraday, well, let's check out intraday. It actually climbed up quite a bit, a little bit of a pullback, but looks like maybe of late, these are 1 minute candles, the last 10 minutes or so, we've had a little bit of a recovery on that. Okay, but here's what I want to do. I want to switch this up and I want to talk about calendar spreads. And so what I'm going to do for that is I'm going to actually bring up a doc and I'm going to do what I've done on our other strategies over the past few weeks. And that is just kind of give a summary, kind of a quick data dump on different aspects, important essentials of the strategy. Then after that, I want to actually look at the markets and actually look at potential calendar spread example trades here on that we'll do. Okay, so that's what we're going to go through today. So what's a calendar spread? A calendar spread, calendar implies time. It's a time spread where we're going to, you're either going to trade 2 calls or 2 puts, and one is going to be long and one is going to be short. Okay, one is going to be long, but from that standpoint, that sounds a lot like a vertical spread, right? But it's different. It's different because we have different expirations and same strike. So on a vertical spread, which a lot of you are familiar with, we're using different strikes. We're using the same expiration. Flip those around, different expiration, same strike. That's a calendar spread. So typically, it doesn't have to be this way, but typically we're going to sell the near-term expiration and we're going to buy the long-dated expiration. Okay, so that's how they are. Now, is it still a counter spread if we reverse that? Yes, but more often than not, we're not going to do that for a couple reasons. One is your margin requirement is probably going to be higher, and you're bringing in more risk, more types of risk if you reverse that. Also, by doing it the way we're doing it, what we get positive theta. By selling the near-term contracts, you guys, we've talked, you guys are familiar with this. With options, the closer you get to expiration, typically the closer you get to expiration, the more time decay eats into your contract. So if you're selling the near term where time decay helps you, then it's going to help you out. So it's going to be positive theta trade. Okay, it's going to be positive theta trade there. And so that's that. Now, let me just stop right here for 1 sec, because right now, in addition to this webcast, we have a workshop out there in Dallas joining us. We're so glad you joined us, Dallas. I've never been to Dallas. I want to come to the Big D sometime. You're in good hands with Ben and Scott and Ray, and I think Barb is out there too. Wow. You guys are in good hands there, everybody. Enjoy your workshop. And for all of those who aren't in Dallas right now, make sure you check out one of our workshops. This is an advanced options class. So if you want to continue with your advanced options education each week at this time, when you're not sitting in your workshop there in your class right there, you can join us here. Okay, so let's continue with what we're talking about. Calendar spreads, positive theta. If we sell that near-term expiration and buy the longer dated expiration, you're going to have a positive theta trade. Time decay is going to help you out on that trade. Now, something you need to know about this. These are, well, before I get to the directionality of this, I also say they are positive vega trades. Now, in our market right now, you guys have seen the VIX. The VIX has been coming down. If implied volatilities continue to come down, that is going to tend to work against your trade. Therefore, what we're going to do is we're going to look for trades where the implied volatility has already come down if it was high, and almost everything has had a high implied volatility. But we're going to look for those stocks where the implied volatility has already reduced to a lower level there on that. Okay. Now, think about this. Think about this. I mentioned a webcast I did on Wednesday where we talk about how to help identify some of those with those lower implied volatilities. All right, but let me mention that this is a non-directional trade. Now, it's truly not totally non-directional. The stock doesn't have to go completely flatline, but generally we don't want huge movement out of that. Hey, think of it this way. If I want to do something like, and I think my stock is going to be going way up, maybe you'll consider something like buying the stock or doing a long call or something that way, or vice versa. If you're really bearish, if you're more neutral, then that's where calendar spreads come in. But even if you're maybe a little bit bullish, not very bullish, but a little bit bullish, can we skew this positive? Yes, we can. So I'm going to say non-directional, but the reality is you can skew it a little bullish, you can skew it a little bearish, and the key is it just depends what strikes you choose there. It depends what strikes you choose. Okay. Chris said, do we want low and rising volatility or low and expected neutral volatility? That's a good question, good clarification. Ideally, let's consider the stock and the implied volatility. On the stock, we want the stock to remain or go basically sideways. So low volatility in terms of what the stock is doing. In terms of implied volatility, remember implied volatility is expected future volatility. Ideally, it's starting off low and going up. Now, I will tell you this. Generally, other than big moves, implied volatility isn't necessarily going to make or break the trade totally. Look, you got one short contract, you got one long contract. They're going to kind of offset each other to a large extent. So some volatility moves probably aren't going to kill you on this. Ideal situation, to answer your question directly, Chris, it'd be low and going up. Okay, low and going up. All right. So that's why it's good, something we need to think about here on this. And that's why we're going to look for something that's low. Now, how does it go up? Well, very often it'll go up if the stock drops a lot. So that's why some people prefer put calendars to call calendars. In other words, they anticipate the stock. They find stocks that they think may go down a little bit, which will help to boost the implied volatility. We'll have to see on that. Okay. Now, practically, what are we going to do? Here's some kind of guidelines, but they're not, these are not written in stone here, folks. So in this class, we're going to teach doing the short options 20 to 40 days till expiration. The long option, the way we're going to teach it in this class is we're going to go 40 to, I don't know, 120 days till expiration, something like that. Usually I'm not going out all the way to 120 days. But one thing is, the bigger the difference in your expiration dates, the bigger the difference there, the more expensive it's going to be. And your max loss is going to be basically your initial debit. Okay, so you're taking on more risk if you widen the difference in expiration dates on those. All right, if you widen the difference in expiration dates. Now, there's some pros to that. It can cost you more. That's the con. The pro is you may have a bigger difference in the time decay element in there. It will give you the opportunity potentially to roll the short contract out. So those are all, so there's pros and cons on this. One thing I do need to caution you on, though, is generally, I'm going to say this is a slow-moving trade, okay? I have experienced this personally, and I know I've talked to a lot of you who have experienced this. You do a calendar spread, and you go, well, I think this stock is going to stay pretty neutral, or it's going to go to this strike, maybe up a little bit or down a little bit, but relatively neutral. And it does pretty much what you want it to do. And you look up, and a week later, you've made all of $3 on the trade or something like that, So it can test your patience, because we're not going to get big effects from delta. We're not going to get big effects typically from the stock price movement helping it out. We're really reliant on that theta helping us out. And theta can be kind of a slow-moving aid to your trading. So just a heads up, if you're one of those people that wants to see big gains quickly, this is probably not the trade for you. I would encourage you, whether you love this trade, you like the idea of it or not, one thing I would encourage you to do is to paper trade these, test them out. That's how you do it. Okay. Generally, it's not a high probability trade, not high prob, and it'll shift. You can get it in the above 50% probability, but generally I would say it's not. But the good side of that is usually you have a relatively limited loss, okay, potential. And that's the initial debit, okay? Initial debit. So that's kind of how that is. Now, of course, we got to look at it trade by trade, instance by instance to make a final judgment on that. But those are just some generalizations on that. Let me go through. I've got a few more here on management, and then I want to get to actually looking at trades here. By the way, the one nice thing on this is typically there's a pretty low capital requirement on these. Capital requirement, and that would be different if we reversed the near-term and long-term expiration in terms of what you're buying and what you're selling. Okay, let's go to, let's see, I wrote some notes down. I just want to make sure I hit everything I want to hit. Okay, in terms of management, okay, here is management. I would say we're going to look to roll if near strike price and short is less than 10 days, let's say DTE, 10 days to expiration. Okay? There we go. Okay, roll if near strike price. So, and you're still neutral, okay? And you're still neutral. You're not going to roll, you're not going to continue a trade if your forecast totally changes. That's true for, say, a long call even. If you're looking at a long call and you consider rolling the long call because it's been doing well or something, but you're now bearish on the trade, it wouldn't make any sense to continue with that trade. We're going to exit. Oops. Okay. We may look to exit, and we're not going to look for our max gain, because the way calendars work, if you look at a calendar spread on a risk profile, we'll look at this in just a little bit on the real life. when you look at the max gain, I'm going to do MG for max gain. It's a little peak there. The odds of you hitting that max gain right on the nose are probably minuscule. So we're not going to rely on that. In fact, in terms of our exit there, what we're going to do, is we're going to exit maybe 25% to 50% of max gain. Okay, number 12. Let's see, we're on 12. Okay. We're going to exit at a, did I number these right? Yeah, exit. We're going to exit. So this is our management with a technical breakdown. Remember, this is kind of a neutral trade. If it's no longer neutral and we think this is going to start trending up a lot or trending down a lot, we'll probably look to get out. We're going to exit with less than, that's not the right key, less than 10 days to expiration. And I think I got one more here. Oh, money management. Okay. In terms of money management, we're going to risk one, for our purposes in this class, we're going to risk 1 to 2% of our active portfolio. Okay? Portfolio. There we go. Now, often on these, people will say, well, can you show this? And so I want to take a screenshot or something. You can take a screenshot if you like that. Just a reminder, this is not a, absolute rules. These are just how we're doing it in this class here. All right. So let me go. I want to show you what one looks like. I'm just going to do what I did last week because I thought it worked out fairly well. And go to the spread book, find some actual trades that are out there, and we'll look at an actual calendar spread out there and in the market. So let's do that. Let me head on over to the Thinkorswim platform. I'm going to go to the scan tab. I'm on the spread book. I just put in calendar for spread, and what I'm going to do is I'm going to just analyze this. I'm going to analyze this trade. So this is a calendar spread. Okay. And that was not supposed to be SPX. PYPL, I think, is what we clicked on, isn't it? Yeah, here's a calendar spread. When I talked before about that max gain being just at a little point, there it is. That's the little point. We're not getting it, but you can see that max gain is up over $400. Okay, our max loss is less than 200. Okay, we can look at see what our actual debit was on this to see what our max loss would be. Because remember, max loss, it's 2 contracts, 90 each, so it'd be 180 would be our max loss on that. All right. So let me just check questions and comments. George says, can you use calendars for an earnings play before Yes, you can. There's a specialized use of calendars, and I will hit this up again. I've done it in the past. It's been a while. I will use calendars in a specific way over earnings. It's outside of the scope of what I'm going to get in today, George, but it's a good point you bring up. You can use calendars with earnings play. Can you explain what a popcorn trade is? I have no idea what a popcorn trade is. I may be something I'm aware of, but I don't just not used to that terminology, popcorn trade. I'm not sure. Maybe Cam knows. I'm not familiar with that terminology, popcorn trade. Okay, but let's look at this. This is we're buying. This is what this person did. They're buying the July 18th. They're selling the June 20th contract. Here's my debit on this. And you can see this is relying on time decay. The purple line represents where we're at right now. This represents expiration. And as time progresses, this purple line is going to move up. If it's below where the blue line is, it's going to get closer to that green. So you can see that how important that time decay is there. If this is where the stock is right now, it's not getting any better if we go up or down here on this. The trade just gets worse. So that's why we're calling that a neutral trade. Okay? So that's an example of a calendar spread. Yeah? Now, let's look at our own. Now, remember, there's a couple requirements. We want a stock that's going to be relatively neutral. I'm going to go to a year chart here on this and just kind of give us, not a 1 minute chart. Let's go to a 1 year chart, okay? And I'm going to pull up Intel, INTC. Okay, so here's Intel. Can you see what I'm talking about? We've had a relatively, we've had a channel, is what I'm going to say on Intel. Okay, we've had a channel. Now, there's been more volatility, but remember, I don't just want the stock to be kind of having more of a neutral forecast on that. And I'm going to click on implied volatility. I'm going to just look at our implied volatility. Remember, ideally, that implied volatility goes up for us. But what I don't want it is to go down too much. Here's our implied volatility right now. It's right there. And what you can see is we've already had a huge diminishment of implied volatility. Part of that is because we're past earnings here on this. And again, I'm not going to hit up earnings trades on this, but we're past earnings on this. Our implied volatility is already sold off. And so what we don't want to have happen is we don't want implied volatility to just keep on going down and down and down, which is certainly a possibility, but it seems less likely given the drop we've already had in implied volatility. Okay, let's go and do this there. Let's look at the trade. What's our forecast? That's always the question. What's the forecast? And so what I'm going to say is, I'm going to say, well, we're kind of neutral-ish, but I'm going to maybe we'll kind of stay mid-range-ish on this trade there, mid-range of the channel. So I'm going to go mid-range is kind of right around the 21 area. So do you see how when I say I can skew this a little bit bullish, a little bearish, stock's about 20. If I were truly neutral on this, I would just probably pick a 20 strike. Okay. I'm going to skew this a little bit bullish. I'm going to make it about a 21 strike here. So let's take a look at it. I'm going to go to the trade tab. I'm going to go to Intel. Here's Intel. And I'm going to go out. I'm going to do our, I'm going to go out. Remember, we said 20 to 40 days. I'll go in the middle of that. I'm going to go 23 days out. I'm going to look on the calls. I'm going to go to the 21 strike. I don't need that many strikes here. I'm going to go to that 21 strike. I'm going to sell this contract. Our liquidity is pretty good here on this. A lot of open interest, 3-cent bid-ask spread on this. I clicked on the wrong one. May 23rd, that is 7-cent bid-ask spread, 6-cent bid-ask spread, about 619 open interest. That's probably okay. I'm going to sell this. Just click on the bid price there. I'm going to buy, and I'm going to go out a little bit. I'm going to go out. We'll go out to the, remember we said 40 days or more. I'm going to go to 56 days, okay? Here we do have a lot of open interest on this one. Bid-ask spread, and I'm going to buy this one. I'm going to hold down my control key. And there we go. Now let's just analyze this trade. I'm going to right-click on this. I'm going to analyze the trade, and we should see, this is kind of the familiar calendar, what the familiar calendar looks like there on that. Our max gain on that. The max gain, you can't tell, you don't know just from this information here. It's going to depend on pricing and whatnot. I'm going to go here and say, look, max gain is right around, I'm moving my mouse, $75. What's going to be my max loss? About 40 bucks, okay? What's my profit or loss on this? Let me go to May 24th, that's good. I'm going to go click on set slices, break even, so we get a sense of our probability. Now, I told you already, it's not a high probability trade, about 43%. We certainly can potentially gain more than we lose, but our break evens are about 23 and a half and about 19. Let me just jot that down. 23 and a half and 19. Does that make sense with our chart? I'm going to set my slices to my chart here. Set slices to charts. There we go. And I actually, unfortunately, they're the same color. These ones that extend all the way to the left are where my break evens are. This was just a channel line I drew. But so here's what I'm going to do. I'm going to say this. I'm going to actually activate this. I'm going to say that was our channel, but I'm going to go up a little bit. I'm going to go up here and say there's kind of a resistance level. And I'm going to go down here and I'm going to activate this guy and I'm going to say, where's my support level? Well, support level is right about where we're at. Okay, so I'm going to get out of this if we break below our support or above our resistance. We're going to look to exit this trade. I'm going to put an automated exit to get out at that point. Now, hopefully we get a little bounce up and we go right in this. This is the sweet spot right there. This is the sweet spot right there. Right, 21 is where we want this to go. Your exits don't have to be right where your break evens are. Because, even if we go to break even on this, look, if we go down to break even right now, what's our loss on this? It's going to be, with a lot of time till expiration, our loss is probably going to be pretty minimal. Even if we go to our break even points, or beyond beyond our break even points here before expiration. So if we go down to the $19 level, where our other support was, we're doing fine. If we go up to the sorry, I missed that. We said 25 and 18. 25 and 18. Okay. If we go down to 18, we're not going to be at our max loss. So right now, this is showing a $14, $15 max loss, or not max loss on this trade at that point, okay? $15. If we go up to, I think we said 24, our loss on that trade is about $10. If I go up to $25, our loss is about $20. Yes, we're losing money, but I'm just trying to mention there's no urgency necessarily to get out of this trade at this point, okay? So there we go. I'm going to take this trade. I'm going to make it a first trigger sequential order. I'm going to right click on this. I'm going to create an opposite order to get out. Now, if we get to within, well, we'll say less than 10 days till expiration, our near expiration is May 23rd. So on about May 13th or less, we're going to look to just either get out of this or perhaps roll this trade at that point. Okay. Did I not adjust my dates? Did I not adjust my dates? 520, 421. Oh, this should be 425, shouldn't it? Let me do that. 425. Okay. And this should be right. That's right. Okay. So that may have moved it just a smidge there. Okay. How did I draw? So question from Myron. How did I draw the purple break-even lines? Okay. So when you're using the risk profile tool, put in your trade down here and make sure it's the only trade down there. Number one. This date should be today's date. Okay. This date should be 1 day after expiration. Okay. And then if you want to set those break-even points, what you do is go over to the little 3-line menu right here, go to set slices to break even, and you're going to go right there, okay? And there you have those right there. So hopefully that answers that question. Okay, so Aora says, when should we roll the short dated call? Typically, we would roll with less than 10 days to go to expiration. One reason is this. If we're looking out much before that time, like within a week from now, there's probably a minuscule chance this is going to be super profitable at that point, to the point where it's going to be worth rolling at that point. All right. So there we go. Let me go back to my trade here. And what I'm going to do is I'm going to say, I want to get out of this market, good till canceled. I'm going to click on my gears, and we're going to get out if Intel marks less than or equal to, and I keep forgetting to, okay, hold on. Less than or equal to, I'm going to say 18 or 25. 18 or 25. Let's try this again. Intel marks less than or equal to $18. This is going to be the technical breakdown I was referring to. If we're no longer neutral on this, if we're breaking our support and resistance level, our bounds there, at that point I'm going to get out and try and, we'll probably be at a loss, but we're going to try and salvage what we can there. And I'm going to click on save. Okay, so there's our entry, there's our exit. And if I want to, I can always, do more than one contract. We can do 2 contracts. And one possibility when you do 2 contracts or more is you can get out some and you don't have to get out all in and out at the same time here. Okay, so I'm going to confirm and send. I'm going to throw this one in our calendars bucket there. We're going to send this, and over the weeks, if things cooperate, if the market cooperates, we will we'll look to manage and maybe roll this. Just a reminder, we're going to get out if we get under 10 days to get expiration, either get out or roll. We're going to exit if we break our resistance or our support level. And if things are going well enough earlier, if we've made 50% of our max gain, yeah, we'll get out at that point probably, or possibly roll. So that's the Intel trade. There's another one I want to look at here, kind of along the same lines here of, I was looking at this earlier. Here's IBM. And IBM, I was looking at this. So here's our volume profile. Volume profile just shows the amount of volume by price, okay? How many shares on the stock have traded at a particular price? And you can see there's a big hump right here. That's where most of the shares are trading. And in theory, with the volume profile, that's going to be kind of an area where we'd expect more trading to occur. Okay, that's where we expect more trading to occur. And so what I'm going to do is, my expectation is, even though the stock's at 232 right now, which is right up here, my expectation is we may drift down just a little bit. And it's put me more in the 225 range on that, okay? And you can see, similar to Intel, our implied volatility has already dropped a ton. This is I'll try and draw my line as straight as I can here. This is where our implied volatility is right now. And you can see, yeah, I mean, it can go lower. There's no doubt it can go lower, but it seems like most of that drop is probably out of the way. So the implied volatility effects of it dropping are probably not going to hurt us as much there on that, okay? So remember, implied volatility is something to keep in mind here on these trades. So I'm going to look at the 225 strike on this. And let's see, I'm going to do puts. When do you do calls? When do you do puts? Typically, we're going to try and keep these out of the money. Remember, options can be assigned early. Short options can be assigned early. And if they're in the money, there's a higher likelihood of them getting assigned early. We're going to try and avoid that. So I'm going to pull up Intel. I'm going to go out And I'm going to do, instead of May, we're switching up just a little bit this time. I'm going to go May 16th instead of May 23rd. May 16th, 21 days. So this is kind of nearer term. Now, you can, and often I do see a lot of trades where people are doing calendars where they're only a week apart or 2 weeks apart. You can do that. You absolutely can do that. But you're probably restricting yourself on the ability to roll if you do that. Okay, so I'm going to go to May 16th. I'm going to go to the puts because those are out of the money. I'm going to sell that. I'm going to go out a little farther. July 18th. That's going to be more expensive if I do that. Like if I compare July 18th and July 20th, June 20th, that's 84 days out. Look at this. If I do this, I'm going to buy this one. That's a 463 debit. That's kind of expensive for a calendar in this case. If instead I do June, what was our date? June 20th, I think. 288. There's the, that's reducing the risk. It's also reducing the number of roll opportunities we're going to have too on that. But there we go. Let's, these are puts. Let me right click. I'm going to analyze this trade. This is what it looks like. Max gain, what do we got? About 457, 459. Max loss is 290. So not quite twice as much, but let's also check out our probability on this. 425 is our current date. Expiration May 17, we're already on there. So I'm going to set my slices to break even. It's roughly a 50-50 trade, 51% trade on this, okay? So that is why, by the way, that is why our max gain isn't that disproportional to our max loss, okay? Maybe we potentially gain more than our max, but remember, that's the pinpoint. We're probably not going to hit right there. But just as a generalization, the bigger difference between your max gain and your max loss, if you get the bigger max gain as compared to the max loss, your probabilities are probably lower. This one we actually eked out into higher probability range, that is above 50%, barely. And remember, probabilities are they're not guaranteed, right? That's just, we're trying to use the numbers to try and help us with this on that, okay? So there's the trade. So let's go and let me do this. And Mark says, I don't like the look of this IBM trade as much as I like that Intel trade. That is fair enough. That is, you're not going to like them all equally. And as I mentioned, this is kind of a tougher environment right now. And I was kind of having to search for ones with those lower implied volatilities. But let's add this, let's add our slices, set slices to our chart. And IBM. And here's our slices right there. Those are our break-even slices. That's our break-even. We want the stock to stay in there. But we do have a resistance up here that I'm going off the high point on that. High point, as if we break above that, I'm looking to exit. And that's about 250. Okay, that's about 250. Let me just jot that down. Low point, support down here. That's about, what do we got? 203. So I'm going to put my exits. I'm going to put my exits there. There's my implied volatility. To do this trade, I'm going to go back here. I'm going to right click. I'm going to actually create an opposite order to get out. And I'm going to do the same thing. And I'm just about out of time here, folks. Let me go to market, good till canceled. We're going to put an exit on, oops. Yeah, no, that's okay. We're going to put in exits, 2 exits. If IBM marks less than or equal to 203, or if IBM marks greater than or equal to 250, 250. Okay, there we go. I'm going to save that. I'm going to confirm and send, and I'm going to throw that in our calendars bucket there. We're going to send that, and we filled right away on that. Now, everybody, thank you so much for joining me today. We talked about calendar spreads. We talked about some general guidelines that a lot of investors use, and not that a lot of investors use, but what we teach in this class and what I use in this class for our management here. And I want to thank you. Coming up next, we have ThinkScript studies. So make sure you check that out. Thanks, Cam, for helping us out. Thank you all for joining me, and have a wonderful weekend ahead. Bye-bye, everybody.